What if I told you that a single barrel of oil could decide whether your next grocery bill breaks your budget? That the conflict raging 1,000 miles away in the Middle East is quietly reaching into your wallet, your investments, and your future. Welcome back to Bankers Bootcamp, where we decode the forces that shape our financial world. I'm your host, and today we are diving into our second story for the series GRWM for interviews, i.e., rising oil prices driven by escalating Israel-Iran conflict. In just the past month, Brent crude has surged from under $67 to over $75 per barrel. That's a 13% spike in a matter of weeks. But this isn't just about numbers on a screen. This is about a fundamental shift that's about to reshape global economics, and India is right in the crosshairs. Over the next 12 minutes, we are going to break down exactly what this means for India's economy, the Western world, Middle Eastern powerhouses, and the entire geopolitical chessboard. We'll examine how your stock portfolio is being affected, and I'll reveal two critical factors that most analysts are completely missing. So let's get straight into it. The tremor hits India's economic foundations. Let's start with the harsh reality. India imports over 85% of its crude oil. When global oil prices spike, India just doesn't feel a pinch. It feels an earthquake. Here are the numbers that should worry you. Each $10 increase per barrel of crude oil inflates India's annual import bill by approximately $15 to $17 billion. With Brent crossing $75, we are looking at an additional burden of $9 to $11 billion compared to earlier projections. But it gets worse. India's account deficit, which was relatively manageable at 0.6% of GDP, is now projected to widen to 1.3 to 1.7% of GDP if oil stays above $75. That's a massive deterioration that puts pressure on our currency, our foreign exchange reserves, and on our overall economic stability. The rupee has already started feeling the heat. Between June and July 2025, the rupee depreciated from 85.35 to 86.84 rupees per dollar, a 1.75% decline. And here's the kicker. Every 1 rupee drop in the rupee's value against the dollar adds another 8,000 to 10,000 rupees crore to our annual oil import bill. India's forex reserves, which stood at a comfortable $688.9 billion, have already declined by $9.3 billion as the RBI intervenes to support the rupee. This is a classic example of how external shocks can quickly erode the financial buffers that took years to build. The Western world, inflation's unwelcome return for the Western economies, particularly the US and the Europe. This oil price surge is reigniting their worst nightmare, inflation. In the United States, sustained oil prices at $75 could push the consumer price index CPI from 3% to 3.5% by the year end. If the conflict escalates and oil hits at $135 per barrel, which JP Morgan considers a realistic worst case scenario, US inflation could spike to 5%. This would be a catastrophe for the Federal Reserve policy. The Fed has been carefully orchestrating rate cuts to support the economy, but rising oil prices could force them to reverse the course. Higher inflation means higher interest rates, which means slower economic growth and potential recession risk. Europe faces an even more complex challenge. The continent is already dealing with the energy security issues stemming from the Russia-Ukraine conflict. Now, with the Middle Eastern supplies at risk, European refiners are scrambling to secure alternative sources, often at premium prices. This double whammy could push Eurozone inflation close to 4%, derailing the European Central Bank's monetary easing plans. The ripple effects are already visible. European refining margins are under pressure. Energy-intensive industries are cutting production, and consumer confidence is plummeting across major economies. Impact on the Middle Eastern countries. Winners and losers in the oil game for oil-producing Middle Eastern countries. This crisis presents a paradox of profits and peril. The winners, countries like Saudi Arabia, UAE, and Kuwait, are seeing their revenues soar. Every $10 increase in the oil prices adds approximately $40 to $50 billion annually to Saudi Arabia's oil reserves alone. The kingdom's ambitious Vision 2030 project, which require massive capital, are getting an unexpected funding boost. But here's a twist. The same countries need regional stability to attract foreign investment and tourism. The UAE, which has positioned itself as the Middle East's financial hub, is watching nervously as the geopolitical tensions threaten its carefully cultivated image as a safe haven for international business. The losers, Oil importing Middle Eastern countries like Jordan, Lebanon, and Egypt are facing severe economic strain. Lebanon, already in economic freefall, could see its energy crisis deepen. Egypt, which imports significant amounts of oil products, is facing additional pressure on its already strained foreign currency reserves. Iran, despite an oil producer, is caught in a complex situation. While higher oil prices boost revenues, international sanctions limits its ability to capitalize fully on these price gains. The country's oil exports, estimated at around 1.3 million barrels per day, generate critical hard currency, but the conflict is disrupting even these limited flows. The geopolitical realignment, a new world order in the making of this oil crisis, is accelerating fundamental changes in global geopolitics that will outlast the current conflict. First, we are seeing the weaponization of energy supplies. The Strait of Hormuz, through which 20% of global oil flows, has become ultimate geopolitical choke point. Iran's threats to disrupt this passage have elevated it from a regional waterway to a critical component of global security architecture. Second, countries are rapidly diversifying their energy partnerships. India, which sources 35 to 40% of its oil from Russia, is under pressure from US to reduce these imports. This is forcing New Delhi into a delicate balancing act between economic pragmatism and geopolitical alignment. Third, we are witnessing the emergence of alternate payment systems. With traditional dollar-based oil transaction under strain, countries are exploring arrangements in local currencies, further challenging the dollar's dominance in the global energy markets. The conflict is also reshaping military alliances. The US Fifth Fleet's continuous presence in the Persian Gulf is no longer just about protecting American interests, it's about maintaining global economic stability. Any disruption to Middle Eastern oil flows could trigger a worldwide recession. Now the impact on the Indian stock market. The FII, DII, FDI battleground. The Indian stock market has become a fascinating case study in how global crises play out in domestic financial markets. Foreign institutional investors, FIIs, have been on a massive selling spree. In 2025 alone, FIIs have pulled over 1.5 lakh crore rupees by mid-year, one of the largest outflows in the recent history. The oil crisis has accelerated this trend with an additional 11,591 crore rupees withdrawn in just 1 week during the peak of the Israel-Iran tensions. But here's what's remarkable. Despite this massive foreign selling, Indian markets have only declined 3 to 4%. Why? Because domestic institutional investors, DIIs, have stepped up like never before. DIIs have invested over 86,000 crore in equity markets this year, nearly neutralizing the FII's outflows. The monthly SIP, Systematic Investment Plan, flow has reached 19,300 crore rupees, providing a steady stream of domestic liquidity. This represents a fundamental shift in market dynamics. India is becoming less dependent on foreign capital and more resilient to external shocks. Foreign direct investment, FDI, however, tells a different story. While portfolio flows have been volatile, FDI inflows have remained relatively stable at 1.5 lakh crore rupees in the FY 2025. This suggests the long-term investors still view India as an attractive destination even as the short-term traders flee. Now, what's the energy security dilemma? India's strategic crossroads. Here's the first critical factor that most analysts are missing. India's energy security strategy is at a historic inflection point. India has been successfully importing discounted Russian oil, saving approximately $2 to $3 billion annually. But US pressure to reduce these imports, combined with the current oil price surge, is forcing India to reconsider its entire energy sourcing strategy. If India completely shifts away from Russian oil, it would need to pay an additional $9 to $11 billion annually for alternative sources. This isn't just the economic decision, it's a geopolitical one that could determine India's foreign policy orientation for decades. The government is quietly exploring long-term contracts with Gulf producers and even considering increasing strategic petroleum reserves. This shift could fundamentally alter India's relationship with major oil producers and reshape its position in the global energy markets. The currency war dimension, dollar dominance under threat. The second factor that's being overlooked is how this crisis is accelerating the erosion of dollar dominance in the global energy markets. Countries are increasingly settling on oil transactions in local currencies. China is pushing for yuan-dominated oil contracts, Russia is demanding ruble payments, and even India is exploring rupee-based trade mechanisms with friendly nations. This de-dollarization trend, if it gains momentum, could fundamentally alter global financial architecture. The US dollar's role as a world's reserve currency has been one of America's greatest strategic advantages. If oil, the world's most important commodity, starts trading in alternative currencies, it could mark the beginning of a multipolar monetary system. For India, this presents both opportunities and challenges. On one hand, settling oil imports in rupees could reduce currency conversion costs and foreign exchange risk. On the other hand, it could complicate relationships with traditional allies and require sophisticated new financial mechanisms. Now, the banker's bootcamp analysis. The road ahead. So, where does this leave us? The current oil crisis is more than just a price shock. It's a stress test for the global financial system. For India, it's revealing both the vulnerabilities and strengths. Our heavy dependence on oil imports remain a critical weakness, but our growing domestic financial market resilience is a source of strength. The key indicators to watch. If Brent crude sustain above $80, expect India's current account deficit to worsen significantly. FIS flow will likely remain volatile until global risk appetite improves. The rupee will face continued pressure, requiring RBI intervention. Domestic consumption could slow as transportation and energy costs rise. But here's my contrarian view. This crisis could actually accelerate India's transition to renewable energy and improve its long-term energy security. High oil prices make solar and wind power more economically attractive, potentially reducing our import dependence over time. Now the final verdict. Crisis as catalyst. Ladies and gentlemen, we are witnessing a pivotal moment in global economics. This oil price surge, driven by Middle Eastern tensions, is reshaping everything from monetary policy to geopolitical alliances. For India, the challenge is real and immediate. But if history has taught us anything, it's that India has consistently turned external pressures into opportunities for internal reform and growth. The question isn't whether we'll weather this storm, it's how we will emerge stronger from it. What's your take? Are we looking at a temporary spike or a fundamental shift in global energy dynamics? How do you think India should navigate these turbulent waters? Let me know your thoughts in the comments below. And if you want to stay ahead of the curve on the biggest developments in finance and geopolitics, make sure you subscribe to Bankers Bootcamp. We are here to help you understand the forces that shape our world and make smarter decisions about your financial future. Hit that subscribe button, ring the notification bell, and I'll see you in the next episode where we'll be diving into another game-changing development that's flying under the radar. This is Bankers Bootcamp, where finance meets reality.